Welcome to Straight Up Mortgage with Madi, and today we are going to talk a bit about ratios, debt to income ratio and the loan to value ratio. These two ratios are extremely important as a processor. It's something that you deal with every day, all day. It's just a thing. It's not anything to be afraid of or be intimidated by. It's just information to help you get your loan to closing. I'm gonna make this a short video as I try to make or live my videos. All right, DTI. So DTI, again, debt to income. There are two ratios, right? Two debt to income ratios. There's what we call the front end ratio or the housing expense ratio. And to find that, it's your total monthly housing expense divided by your total monthly income, right? So let's say you make $4,000 gross per month and you pay $1,000 in rent a month. And let's just say those are the figures that you need to calculate your front end ratio. So now you would take that $1,000 and divide it by the $4,000, which I believe is like 25% or something. Now here's the thing, because I use the example of rent, but let's say you are refinancing and we want to know what your front end ratio is. So it's not rent now. We're using your principal and interest payment plus your taxes and insurance. Plus, if you live in a condo and you have to pay a monthly HOA fee, we're counting that as well. And all of those figures will add it up, and then we'll divide it by your total monthly income to give you your front end ratio. Now, typically we don't have any issues when it comes to the front end ratio. Things start to get a little bit tricky when we are calculating our back end ratio. And normally when we're talking about DTI, we're not talking about the front end. We're talking about the back end. We want to know what is the debt to income ratio of everything. So when you are calculating, your back end ratio, it's your total monthly expenses, and those expenses include whatever is listed on your credit report. So if you have credit cards, if you have car loans, student loans, whatever you're paying on a monthly basis, that is reflected on your credit. So like your cell phone and light bills and things like that, we don't count because we technically don't know about them because it's not listed on your credit report, and we're not necessarily going to ask you for those items or that information. However, we will take all of the figures on your credit. We'll also take, let's say if we're looking at your pay stubs and we see that you took out a 401k loan and now you have to pay back on it, we'll count that debt against you. Let's say if you have to pay child support or alimony, those things are also not listed on your credit report. However, we'll count those debts against you. So again, total monthly expenses, including everything that I just spoke on, and plus your housing expense, divided by your total monthly income. So now, with growing up in the industry, just from 12 years ago to today, I remember when I first started, it was always like 40%. The DTI cannot be more than 40%, right? But what you start to learn is it's more about DU, your AUS, DU findings. When you run this number, let's say if you are the thing is, if you're under 40%, you're good. You're good to go regardless. But When you're over 40%, things start to get shifty. So it's like if you're like at a 44%, DU's kind of looking um, for more aspects of your credit profile to kind of offset the risk of the DTI being higher than 40%. So what you'll begin to see is like DU will be like, oh man, this is 44%. We need some reserves, or reserves meaning months of assets, bank statements having enough money in the account to cover, let's say, 6 months of your mortgage payment. So DU will start to look at other risk factors to see how it can accommodate this higher DTI. I know LP, Loan Prospector, it has a new name now. I don't know what it is. It still goes by LP, but it means something else. Really quick, LP is from Freddie Mac. DU is from Fannie Mae. And some mortgage companies strictly use DU, but many use both DU or LP. It just depends, who gives the best who gives the best approval. Like sometimes you run your loan through DU and you get like ineligible, and in order for your loan to progress, you need to have a approve eligible. But if you have this ineligible, then that's an issue, because we got to work through that. Now, what if you ran it through DU and it was ineligible, but then when you went to LP and you ran it, it was ineligible? So like it just kind of depends, because the two AUS systems are similar, but they can kind of underwrite a loan a little bit differently. But yes, so that is the DTI. Again, is your loan amount divided by the value of your home. So let's just say you own a home that is worth $400,000, and you're getting a loan that's $300,000. So that $300,000 divided by that $400,000 is 0.75, which is also 75% LTV. Now, typically, especially for conventional loans, we want the LTV to be under 80%. It's that whole risk factor. With a conventional loan, and just kind of common sense speaking, you don't necessarily want to finance. As a lender, if I'm borrowing money to someone, I do want to see that they can bring some of the money to the table. Something. I don't want to do this 100% financing. I want to be able to have some wiggle room. And that's what that 80% is. That 80% LTV. However, if you are a veteran, VA loans can go up to 100% LTV. Like, you don't have to bring any closing costs, any down payment. And that's one of the benefits of being a veteran. But again, with the loan to value, it is a ratio that you'll deal with a lot, because when you are processing conventional loans and you see that your LTV is over 80%, it's either that loan is going to be dead, like the refi won't be able to happen, or your borrower is going to need mortgage insurance. And mortgage insurance is another monthly fee that, it can be paid. There's like lender paid and there's borrower paid. But either way, the borrower is paying for it. And it is another expense, when it comes to your mortgage. So it's better, I would advise, to wait until you can get your LTV down to 80%. However, if you really do need that mortgage, you really do want that refinance, then you're going to get that mortgage insurance. So different strokes for different folks. It just kind of depends. But I just wanted you to understand these very important ratios, your DTI and your LTV. I'm going to do a a video on second mortgages, and then I'll talk about CLTV, which is combined loan to value, and that's when there is subordinate financing on a property. But thank you for taking the time out to hang out with me and learn about these important ratios, and I will see you on the next